Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh here. It's on Good Friday, and it's a good Friday to spend with you, Jim. I know it's a long holiday weekend for the markets, but it's nice to have you here following the jobs report today.
Yep, jobs report came in, and it, basically shows the labor market. I would call it steady. There's a modest amount of slowing and softening happening. Hours work dropped by 1/10. Wages had downticked to about 4.2 from 4.6. Participation rate ticked up 1/10. Those things are all encouraging to the Fed, but it does not change, the trajectory of monetary policy at this point.
So, this was the month that I personally thought that we would come in a little worse than expected, just in the headline number. Yeah. And that really wasn't the case. So what do you think about the jobs market moving forward? And even the unemployment rate dipped a little bit to 3.5% versus 3.6% as last month. So, what do you say about that?
Well, the main thing is the labor market is a lagging economic indicator, and always been. This cycle, I think it's even more so, Blake, because employers just went through 2 years of struggling to find workers. And so, more and more, they are obviously finding workers because the unemployment rate's at a 53-year low and so forth. So the reluctance has always been there. The last thing you do is lay off a worker. You cut other expenses first, whether it's advertising, non-essential type expense, and then you start to cut hours. So like I said, there's a tiny little softening going on in hours work. You eliminate overtime. And then at the end, when your revenue starts to fall and you're like, wow, business is starting to soften here, I got to react. I got to do more than what I've already done. That's when you lay off workers. So typically you're going to get, a little bit of an uptick, and then you're going to get a curl up as the economy really goes into a more pronounced period of slowing, and then employers react. So that's all, in my opinion. As you know, I've been saying mid-year on, we're going to see the economy slow more aggressively, and that means the unemployment rate's going to tick higher later, the second half, especially into next year. And I think, it's at 3.5. You get above 4.1, that to me seals the deal in terms of a recession. So it's coming, Blake, but there's always the lag effect built into the labor market, and more so in this cycle.
Sure. Okay. That makes sense. I know you have charts showing your views of how you feel the markets have done, but what's your initial reaction to the stock market popping higher? Even though it's good data, it should really signal that the Fed's going to stay higher for longer.
Yeah. And again, the market has ignored that message for a long, long time, really. As we'll see, I think the S&P is going to punch a little bit higher, but I think the stumbling block is encapsulated in this chart. So the red line shows what the Fed funds futures were expecting prior to the regional banking crisis. So this is like the first few days of March, and you can see they were looking for the Fed to raise the funds rate up to 5.66. In other words, beyond the dot plots, which is at 5.1, right? So they were expecting the Fed to be even more aggressive, and then in agreement with the Fed, not cut it until we got into next year. Now, in the wake of the regional banking crisis, the green line shows, no, they're not even going to 5.1. And then we're going to see at least two cuts before the end of this year. And then the blue line is what the Fed has said it's going to do. We're going to 5.1 and we're going to hold it there. So to me, again, the Wall Street is pricing in rate cuts. And if you flash back, in the April macro tides that I just sent out, I go through Powell's his post FOMC meeting press conference, and then his opening statement. And his opening statement was the first paragraph. These are the things we've done to kind of address the liquidity issues from the small bank problem. But then he went back, his labor market's still extremely tight. And so that, I think, is the underlying issue. So unless you get another much more pronounced problem with banking, The Fed's on this course that we're going to stay longer, higher for longer. And I think they're going to nudge the funds rate up one more time to match at least the dot plot. And then their goal is to hold it.
I was going to say, historically, and my tenure in the markets have been since the 90s, basically the mid 90s when I first got my Series 7 license back in 1995. We haven't seen, inflation. We haven't seen inflation,
right.
but you have, and I mean, and you've probably done a lot of work over your career to look at historically. I mean, where we're currently at with the Fed funds rate. I mean, is it that much far off the norm, and could we even go higher than that?
Yeah, we could. I mean, and Powell addressed that. Blake, he said, we're anticipating that lending standards are going to get tightened. It's going to have an economic impact in terms of slowing the economy. And in effect, the increase in lending standards can take the place of additional rate hikes. So again, I think people have to understand that dynamic, that again, they get to 5.1, another rate hike. And if we see lending standards increase, which we are going to see, as you know, 2-3 months ago, I started talking about the increase in lending standards that took place in the third and fourth quarter, and that they had already reached a level that historically over the last 35 years had gotten tight enough to signal that we're going to head another recession indicator. So to me, the key coming up, and this is another theme that we've talked about for quite a while, is that there's going to be a point in time when the economy shows more pronounced slowing. Wall Street, obviously, as this chart indicates, expects the Fed to cut rates pretty quickly. And what the Fed has said repeatedly, Powell and others, that they're not going to do the mistakes of the 1970s. And the bigger mistake, Powell said, would be to ease prematurely, because they want the economy to slow and stay slow for a long enough time to really bring core inflation measures down much closer to their target. So I think we're getting to that window the next handful of months where we're going to see more signs that the economy is indeed slowing. And the Fed isn't going to give any indication that it plans to cut rates. And I think that's why equities have this maybe a 1 to 2 month window where they could be pretty vulnerable. You mean you're not going to lower rates even though things are starting to look ugly? And that's where you get that last selling wave. And that's been my expectation, that as we got closer to mid-year, these things would kind of all come together. And I don't see anything changing. And in a sense, because of the regional bank crisis, it has increased expectations that the Fed isn't going to continue to raise rates, and then they're going to be quick to lower rates. That sets the market up for disappointment.
Well, the next chart you have is about inflation, and there's a word that not a lot of people have been using recently, but I think you're going to hear a lot of it being mentioned a lot more, is stagflation, because we have, we have growth that is. I thought it would really, you'd start to see it this month with employment, but employment and growth, if it's really starts to peel back and reverse strength, but inflation remains sticky, that's stagflation, right?
Yeah. I mean, obviously, if you go into a recession, it's not stagflation anymore; it's a recession, and that is my expectation. I think one of the curveball that's happened is, people talk about the inverted yield curve, but they don't maybe fully comprehend that the average lead time going back the last 50, 60 years between it inverts and when you start a recession is 19 months. Well, the 210 inversion happened in July of last year. So we're just really around that average time period. Leading economic indicators have about a 10-month lead, and they triggered about 6 months ago. So my point is the lag time, and again, contrary to what happened last year, first 2 quarters of last year were negative. People were, oh my God, we're already in a recession. Oh, wait a second, we're not in a recession. And now the view, I think, is, well, with all the Fed hikes that have happened and we're not in a recession, it ain't going to happen. Therefore, no landing. And I just think that the lag time in this cycle has been stretched relative to all the prior 9 or 10 business cycles going back to the 1950s, because the amount of federal government spending and the money that they distributed to consumers. So all of a sudden, a year or so, 18 months ago, consumers were sitting on, $2 trillion, $2.5 trillion worth of savings. Wage growth has been up big time. 26 states in January increased the minimum wage. Social Security, an 8.7% increase in benefits. So my point is, you've had these other factors coming in to, if you will, support consumers' balance sheet to enable many of them to continue to spend. And I think that's why the lead time or lag time, depending on which way you want to look at, between these very reliable recession indicators and an actual recession has just gotten stretched. But I don't think it's negated it. So in terms of inflation, this is the Dallas Trim Mean, and effectively what they do. And they believe this is better than the core PCE, which is obviously the Fed's favorite metric. What the Dallas Fed does is say, okay, let's look at all the inflation categories in the PCE and CPI, and rank them from which ones are up the most over the last 12 months down to which ones are up the least the last 12 months. Let's get rid of the extreme top and the extreme bottom and get the middle part. In September, the bottom line there, may be tough for people to read, was 4.7%. Well, here we are, 6 months later, it's 4.6%. So my point is that this is the kind of stuff that the Fed is looking at that convinces them that, all right, if the economy starts to show more signs of slowing, we got to hold back before we ease policy, because we need to see these kind of numbers really come down much more than where they're at. 4.6 is way above, being in the zip code of 2.0%, which
right.
is
Far.
Yeah, so this is the part I think that Wall Street, and we're going to get another hook on Wednesday. The CPI is going to come out. And as we've talked, the CPI is like a rate of change from 12 months ago. You take away what happened 12 months ago, you add in what happened in March of 2023, and voila, that's your 12-month headline. Well, in 2022, in March, it went up 1.24%. Well, if we only add 0.4 in March of 23, that means the CPI headline is going to drop by 7 or 8 tenths from 6%. So I think you're going to see headline drop to 5.3, give or take, which is a pretty meaningful decline. And again, it's going to get Wall Street, now the Fed can really, now we're sure they're going to be able to ease. And as we've talked really for months now, Powell pivoted away from inflation numbers as being the dominant driving force behind monetary policy to the labor market in his Brookings speech. And he continues to talk about the labor market. Are they glad to see inflation coming down? Absolutely. But for long-term inflationary pressures to subside enough to get down to 2% or something close to that, you need to see wage inflation, labor market tightness unwind. So they're going to welcome the drop in inflation in the next few months. I've said the CPI is going to be down to probably 3.5% or lower by the time we get to June. The key is these other measures of inflation, and Powell has referenced the core PC ex housing, and I think that's north of 4% still as well. So that's the stuff that the Fed is paying attention to. That's the stuff that has convinced the Fed that easing prematurely would be a mistake.
Okay,
and
well,
obviously Wall Street hasn't gotten that email yet.
Yeah, right. No, it sure hasn't. So next you have the dollar. I've been watching this 101.90 level. You've been harping on about. It's a 78% Fibonacci retracement, by the way, of this move. So it's been on my radar as well. That's why
sure
you say it, and I'm looking at it. I know that this is a 78% retracement right here of this move.
Right.
So, and it's held. So, are we trying to make a higher low in the dollar, or what?
That's my bias.
What do you think?
Again, I think that the rally from 101.05 to 105.20 is a wave A, and that this is a B wave coming down here. Now, B waves can undercut 101.05. I mean, you get an irregular B wave. That can happen. The reason why I think that pattern analysis that this is the bottom of a B wave here is, again, people think the Fed is going to be quick to lower rates. I think they're wrong. And as that message comes through, if correct, that will give the dollar another bid. And I think the dollar still, in all probability, Even though it got below the 101.90, that number didn't come out of thin air, as you just noted. But I just think the way things are set up, the dollar has pulled back because of the regional bank crisis. I mean, it topped and has been going down since that exploded. And the idea being is, oh, Fed can't keep raising rates. They're going to be cutting rates. Well, if that supposition proves incorrect, guess what? You're going to get some short covering. You're going to get another bid. And I think the dollar goes above 105.88. Beyond that is another story. But near term, I think that is a likelihood, which obviously would have implications for gold.
Yeah, and gold, I have to say, and this is something that you don't have marked up here, but I'll just kind of draw it out for people. Yeah. There was like a nice little pennant formation, little flag formation trying to break out. But now gold didn't respond today due to, the futures market and whatnot. Yeah. But how do you think gold's going to respond here when the dollar, or if the dollar rallies?
Well, again, the pennant that you just drew on there, to me was a triangle for wave 4. And triangles happen in wave 4 position in terms of Elliott wave stuff. And they're followed by a thrust. And so
which would be the thrust right here.
Yep. And so in Monday's weekly technical review, I said, we're about to see a rally up towards 2030. I think it was 2022 to 2035. It got to what, 2031?
Yeah, somewhere right there.
Okay. So, and again, you look at the pattern from the low. Look at the dollar topped in the first few days of March on the banking crisis, and look at what gold did. The dollar's coming down, flight to quality in terms of gold. Well, again, if the supposition that the Fed is going to be cutting rates in a handful of months and not increasing rates is proven incorrect, I think gold corrects. So the dollar rebounds, gold corrects. Now, from a bigger picture standpoint, and we've talked about this the last few weeks, is the fact that gold got above 1957 or 59. And all of a sudden you got 5 waves up from the low in September. So to me, that just says we're on our way to new all-time highs. This is wave 1, I believe, of wave 5 to new all-time highs. Well, fine. That's a good bullish message. But you got 5 up, which means you're set for a wave 2 correction. And I think, 1920 was an area of resistance going back for quite a while. And then you do a 382 of the whole rally, and I think it's 1850, 1870. And then lastly, wave 4 of lesser degree is the low we saw in February, March, around 1816 or 1807, something like that. Yeah. So those are the price targets. And so to me, it just comes down to how much does gold pull back if indeed the dollar rallies above 105.88. And when the dollar rally looks like it's rolling over, that'll be the time. Gold rallied from September until, what is that? I don't know how many weeks it is. It's a chunk of weeks. I don't know if it's 30 weeks. So my point is this wave 2 should consume, 6 to 10 weeks of time, like a 382 time-wise of the length of that rally. So it's not something that I think is going to happen, in a very, very quick amount of time. So I just think that, and it'll temper some of the bullishness that has developed around gold because it's made a heck of a move.
Yeah, it has. I think people forget too. You have to go back. The all-time highs are up here around what is it?
2070.
Yeah, so 2070, which is somewhere around here. Yep. And people will start getting worried. If you're long and gold starts to come back because there's obviously a strong inverse relationship between the dollar and gold. If it does come down a little bit, I'm sure it'll probably freak out a few people. Not being able to
Johnny come latelys, people who bought the breakout above 1957 or 59, whatever that number was.
Yeah, right here.
Below that number, now they're underwater. It's just, again, this rally I think was predicated on what the Fed was expected to do in terms of not raising rates more, cutting rates more quickly. That whole premise proves false. That's the perfect backdrop for a pullback. To me, though, if this pullback is an ABC or some type of corrective pullback, it means you got to buy it because the next move is going to take you above 2070. And then this high in March of 21, I think, was 2067. And then you've got this high that's getting kind of close, 2031, to those prior two highs. So you get above 2070, that will represent a pretty big breakout, and there should be some fairly decent follow through on that breakout. I just think near term, the way things are setting up, a pullback's coming, and then it's just a question of, trying to identify, the buying point on that pullback.
Well, the next chart you have is the S&P. And so
Yep.
how are you reading this? I mean, you've been correct in anticipating a rally over
Yep.
the last couple of weeks. We got it end of month, end of quarter. But the gains are really, it's a fairly shallow pullback thus far this week. So what do you make of that? And can we go higher?
I think so. From the low at 39.09, you can see a pop up, little pullback, and then a fairly conservative move up to the 41.33. So that to me is 1, 2. That high at 41.33 is 3. This pullback is a 4. So my expectation is the S&P is going to rally above 41.33. I think 41.50 is roughly where wave 1 and 5 would be equal. From the low at 38.09, I think this is a big A, B, C. So again, I think we're headed toward the dangerous part. I've been saying for a while, we're going to come to a window where the economy's softening and the Fed is going to indicate it's not cutting rates, and the market's going to have a hard time dealing with it. I think we're on the cusp of that, Blake. So to me, getting above 41.33, time to do some selling. Can the S&P get above 41.95? It's possible. Again, the CPI is going to come in. Wall Street's going to probably be kind of excited about that. But I think it's time to become much more defensive, based on all the things we've just discussed.
And just as a reminder, CPI does come out next Tuesday for
Tuesday?
those. Is it Tuesday?
12th. I think it's the 12th. Wednesday.
Let me double check that.
We better. This is a key thing here.
Yeah, it actually. Let me make sure that it is the 12th, just to confirm. It's Wednesday the 12th. I'm sorry, you are correct. Okay, so but the point is, next Wednesday we are going to get that CPI data. You think that it's going to come off? I know the last reading was at 6%. Yeah. You think we're going to probably come in well below that?
Yes, absolutely. Now, again, you have mitigating things in terms of oil prices continuing to rally. Yeah. So again, there's going to be this, and the month over month changes. Obviously, people are looking at very critically. Last month was 0.4 increase. Hey, what if it goes up 0.5? Yeah, you got the big drop in the headline, but gee, it went up 0.5, and look at what energy's doing, blah, 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 blah. I honestly, I'm looking for a place to go short. That's where my mindset is. Is it time to go short at 41.50? I think probably partially, and then wait to see until we start to see things roll over a little bit to add, because my expectation is at a minimum, there'll be a retest of that 38.20 level. And if you take that out, Blake, you're talking about the market tumbling.
Yeah,
I think that's what's going to happen. So initially you get a pullback towards the 38.50. You get another bounce because people are, okay, But this is what I've been looking to happen here, really for 2-3 months. Yeah, getting into this window where the economy shows more signs of slowing, and the Fed isn't going to give the markets any kind of a lifeline.
Well, let's wrap up with the bond market. Bonds look very constructive here. And based on your drawings, it looks like bonds might rally. Yields are going to come down. Is it going to be tough for yields to come down and the dollar rally at the same time, Jim?
Maybe. I mean, again, I'm looking at this as a big ABC up from the lows of last October. The first rally was from 91.85 to 109. So that's just 17 points and change. You add 17 points and change to 98.88. That's where the 115, 117 comes from. Obviously, the high last yesterday was 108.87. And you can see the string of highs right around this 109 plus or minus. So can we get a pullback here? Yes. But, as long as you hold above the 103.60 low, which is where I said buy under 103.75. The low that day was 103.60. That's why, I told people to buy under 103.75. With the rebound, been able to increase the stop to 103.60. I don't think we should take that low out if we're going to break out to the upside. So basically right now have effectively a free trade on in anticipation of that. Again, the bond market may take a look at, hey, the Fed's going to keep raising rates. They're not going to back down. We're going to have a recession. So, you could have the dollar responding to the fact that monetary policy isn't reversing anytime soon, and the bond market saying, yeah, it's not reversing, and we're going to get a recession.
There you go.
There's been a lot of shorts in the 10-year and that's been coming down.
Right.
But, because people have been, they've been positioned.
Well, and the thing is I try to explain to our community, my personal, the trading community I'm in, just that you have relationships or correlations in the market, but they break away. And there's things and situations that can do that. I mean, it is possible that the dollar and gold go up together. It is possible that yields go up and the dollar go up together. So those are the things that we as traders need to consider. And Jim, I got to say, thanks for keeping our head on straight. I know we have to be on a swivel during these very volatile times, but keeping us
is attached.
Yeah, it's attached, and you're steering the ship straight. We do appreciate it. And I want to ask how do traders find out more about what you do at Macro Tides?
I'm going to make one more comment regarding the rally that we've seen in recent weeks. Almost all of it's due to I think 5 stocks, concentrated in the Qs, the mega cap stocks. So the overall market is lagging badly. So what happens if those stocks start to weaken up? And again, that's what's coming. And so that's again another little brick in the wall, so to speak, of the scenario. So macrotides.com, shoot me an email, Jim Welsh Macro. I'll send you a recent publication. And as always, it's great to have this conversation with you, Blake.
It is. It's great to have you here, Jim. And I want to thank you for all you do for the Trader Summit community. And I want to wish you and your family happy Easter, Passover, whatever holiday you're celebrating this long weekend. And for our viewers out there, make sure you give Jim and his family a thumbs up, subscribe to the channel so you don't miss any of these interviews. Jim, have a great, wonderful holiday.
My pleasure. And one last thing, it's a great weekend to remember the golden rule.
Always be kind to each other.
Do unto others as you would have them do unto you.
There you go. All right.
That's often forgotten these days.
That's the golden rule. And it is forgotten. Yes, it sure is. Hey, Jim, thank you so much. Always appreciate you. We'll see you next week.
All right, Blake. Take care, bud.
Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.